iTunes podcast host and serial entrepreneur with over 40 million real estate transactions. His extensive investment experience spans the gamut of apartment buildings, single-family homes, office buildings, raw land, condos, and his favorite and by far the most profitable, mobile home parks. Please welcome back Kevin Bupp. And if you've had your minds blown once, it can happen again. Jeremy Roll has been an active real estate and business investor for over 15 years after leaving the corporate world in 2007 to become a full-time passive cash flow investor. He's currently an investor in more than 70 opportunities across over $500 million worth of real estate and business assets. Back up, Jeremy Roll. Thank you, guys. Thank you guys for joining us again, Kevin and Jeremy. And Sean, we haven't had the chance to be introduced to you yet, so I'd love to start with you. Sean, you've been with Timberland for about 5 years. In 2 minutes or less, can you tell us what Timberland is and what you do there?
Sure. Those that know me know I can't answer many questions in less than 2 minutes, but I will do my best. Timberland Partners, multifamily investment firm based in Minneapolis, Minnesota. The firm was started by a gentleman named Bob Franzen 25 years ago. Bob was a struggling apartment broker who had always wanted to get into investment, and long story short, was able to locate a 46-unit foreclosure one day, got 3 of his buddies together. They managed to pool what little money they had, bought the deal. It was on Timberland Drive, so when they had to come up with a name, it was pretty simple. Let's call it Timberland Partners. So fast forward, it took about 10 years for the company to acquire the first 2,000 apartment units, branched out from Minneapolis into Sioux Falls, South Dakota, down into Iowa, bought some deals in that area. From 2002, and in 2002, Bob went full-time into the business to focus just on the investment company. They bought another 3,000 to 4,000 units prior to the crash. Were able to withstand the crash just fine, which was great. I joined the firm in 2011, was hired to help them expand the company further, go to new markets, and just try to help grow the business. We've been fortunate to acquire, in my time there, it's actually closer to 7,000 units now. We've had a good last few months. We focus on apartment communities, 150 to 200 units and larger. We own in 12 different states right now, all throughout the Midwest, and in the last few years, my main focus has been kind of in the Southeast. I've put together a portfolio of about 1,000 units in Nashville, 4 deals outside of Orlando, and we've gotten to Ohio and some other markets. We're long-term holders, typically looking for cash flow. Our investors want cash flow. And then I guess in those 7,000 units or close to have a little over $500 million. So we've had a good run for the past several years and hope to continue it.
Awesome. So kind of along the same thing that we're talking about with Chris earlier this morning, when you're operating at a level of 7,000 units in 5 years, that's a lot of inventory in a very short period of time. You're not looking at one unit at a time. You're looking at a business system. Can you share with us how you've managed to acquire, because you've led the acquisitions, how you've managed to acquire the volume you have for Timberland in such a short time, and what do you do differently buying thousands of units at a time versus 1 or 10 or 50 units at a time?
Well, it's a great question. There's a couple of things, some in our control and some, frankly, outside of our control that we've just gotten lucky with. And the first, I was talking to Joe about this yesterday, the first is technology. When Bob started the company in 1992, frankly, I don't even know if the internet existed then or not. Maybe it did, but it was very slow. For Bob to locate and find deals, he was calling brokers, and he was frankly just going to see what he could in person. With the internet, with technology, I get 50 packages emailed to me every week from all around the country. And I can sit at my desk and quickly, and we have an analyst that works with us, I can quickly go through those and, say yes or no very quickly. So technology has helped just in the sense of deal flow. You're able to just get your arms around so many more properties around the country. So that's been a huge thing for us. The other thing is just at our size, we have a huge infrastructure behind us, and we're able to move quickly on things that we like. We have purchasing power, and we're able to move into markets quickly and jump on stuff that, frankly, it would take other folks a lot longer to get to. So those are, I think that as well as, those that are in multifamily, you've seen the business I call it, kind of become Wall Street in this last cycle. Prior to this last cycle, it was most owners of multifamily were local owners who, built the deals themselves or bought them 15, 20 years ago. The plan was to hold them forever, and at some point, maybe they had a life event or something that happened that created the need to sell a property. But the transaction volume, prior to 2007, let's say, was a lot less than it is now. Now that you have bigger firms, equity firms, Wall Street firms in the multifamily space, they have a very different outlook than the 50-year-old guy who built the deal himself who, wants to hold it for his grandkids. They want to come in, fix something up, and get in and out of it in a much shorter amount of time. So what that has done for firms like us is there's a lot more deals on the market or a lot more deals available to buy than maybe there has been in the past. So that coupled with the technology, I think, are two of the main reasons that we're able to do the volume that we're able to do.
Awesome. Okay, so tactically, if you were, it's the best way to phrase this question, if you were to go out and duplicate Timberland's success, what tactically would you do to go after 1,000 units a year right from the get-go, versus 1 or 10 units a year? So, and I ask that to hear from you, but also to put yourself in the shoes of some of the folks out here. They want it to be doing 1,000 units a year.
There's a couple of ways or a couple of things that I think allow us to do that. Or if it was me tomorrow and I was kicked out the door and said, you need to go buy 1,000 units on your own this year somehow. A couple of things I would do. One is you have to have a sense of where your equity is going to come from. Otherwise, you're going to spend way too much of your time trying to raise money that you could be using to look for deals. One of the advantages I have at Timberland right now is because of our size, we're basically a large company as a real estate investment firm where I don't have to worry about raising money. We have a whole department that all they do is raise money. We have, marketing, HR. We have all the different departments that any big company would have. So I'm freed up to just go look for deals. I don't have to worry about anything else. Once we close them, I pass them off, and I'm on to the next, many. Mm-hmm. So doing it individually, it's a little tougher to do that. And I think part of the reason is, or part of why that happens is, or why people build slowly and one deal at a time is, unless you have the equity and also, let's call it the operational equity, to be able to travel to different places, to be able to look at different deals, to be able to hire the right people, unless you have some money to start with, it's hard to get even a basic infrastructure together. And the way most people do it, similar to how Bob did it 25 years ago, was the first one led to the second one, which led to the third one, and it kind of goes like this. So if I had to do it myself, I would probably go out and make sure before I started even looking for deals that I knew where at least a good portion of my equity was going to come from.
So money first, like Joe always says.
And I would also figure out how much of that money, needs to go to buy deals, but also how much of it needs to go to produce infrastructure for me to allow me to buy those deals. And I think that's a piece of it that gets overlooked a lot.
That's awesome. Scott Lewis was just talking to me about this. We always think about putting the money into the deal. We don't think of it as a bigger business. We think of it as a transactional-based hustle. But sometimes you need to find the money and put it into the administration, the overhead, operating it like a business, like an ongoing concern versus a deal-to-deal organization. So that's great. Thank you, Sean. So that's the institutional perspective. The reason I wanted to sit Sean next to Kevin is because he's transitioning into the institutional approach of investing. But back in 2008, you were doing single houses at a time, right? Or multifamily deals as well, but deal by deal.
Yeah, our main machine was single family. We are first and foremost single family investors. We had a really big machine in place, and we were buying lots of deals. Typically, 25, 30 deals a year, if not more. I was part of a larger partnership, but my portfolio, we were buying a lot of deals per year as buy and holds. Mm-hmm. And the multifamily was always like a default for us, which is kind of funny now that I look back at things. They just kind of came across our desk, and we just acquired multifamily. We were never really focused on multifamily, which I think is where a lot of the problems came into play at a later date, because we had so much of an emphasis placed on single family. We were really concentrated in the Southwest Florida market, as everyone probably knows. It was kind of like ground zero, along with some of the Arizona markets and a few others as well.
And just real quick, it was 122 units
122,
you had?
A single family that I had.
And after 2008, how many did you have?
think I gave all but about six away, so 6 back to the bank. Yeah.
And thank you,
Yeah.
by the way, for being vulnerable.
Yeah,
and sharing
no,
that.
absolutely. I mean, it was a learning experience. I mean, I was actually partnered with people that I admired. I mean, people that had actually been through a few cycles before, and we weren't over leveraged. We had about 63% leverage on our entire single-family home portfolio, but it wasn't just the equity that saw a very quick hit. In fact, we started trying to fire sell things when we realized that things were kind of spiraling downwards, and 85 cents a dollar. 80 cents on a dollar, 75 cents a dollar, 70 cents. Like it went too fast. We couldn't unload them fast enough. And the nail that really sealed the coffin was in Southwest Florida, there was a ton of speculative homes being built. I mean, just like for phantom populations that just did not exist. I mean, rooftops for as far as the eye could see. And a lot of those builders had these finished products. And they had construction loans, obviously. And in order to put a Band-Aid on it, because no one knew how long this was going to last. Everyone just was speculating, even then, how long was this going to last? They started really poaching all the other, residents of rentals in the area. Like a lot of the homes we had were, 70s vintage, 80s vintage, things like that. And so basically they could go rent brand new homes for about the same price as what they were renting our homes. So that was really what sealed the coffin for us. Okay. We lost about 18% of vacancy or occupancy in about 8 or 9 months.
So what did you do differently after 2008 so that you could grow beyond 122 units and not just build an empire, but keep your empire this time?
It's funny because I realized at some point during that cycle that our single-family home portfolio was just inefficient. We had a really good vertical management infrastructure. I had partnered up with a bigger group that had about 600 single-family homes, so we had it in place. But no matter how efficient we tried to make it, it was still inefficient when we compared to our multifamily stuff. I mean, it just seemed like the multifamily just kind of hummed along. It didn't take as much of our time as our single-family portfolio. So we knew, like there was points in time where we just knew that we should have been changing our emphasis. We should have pivoted at some point and really just putting more focus on the multifamily. We just didn't. We just waited too long. And so looking back now, after the crash happened, looking back, I realized, I analyzed my business model. I said, gosh, I kind of knew it at that point, but really the single family is what sunk me. And I'm not saying single family is bad. It's what didn't work for us. It was just inefficient. And I wish I would have spent more time on multifamily. So moving forward, that's what I changed. I knew that getting back into, I took 2 years. I kind of went and stuck my head in the sand for 2 years. I mean, I really did. I went and started a couple other businesses, but it was a really challenging time for me. And when I finally went back to reflect on what sunk my business and what the detrimental factors were, I realized that it was that single-family component. So moving forward, I was like, I'm going to focus on multifamily only. Like that was the efficient way for me to scale my business, to get to the point where I really need to be. And I just knew I wouldn't be able to get there with single-family homes.
And now you've got 50 million assets under management.
So, let me expand that a little bit. So also, in addition to that, diversification of location as well is another big component. So we're kind of forced into diversification of location with our mobile home park investment just because there's not many of them in the United States. I mean, it's not like apartments. I can't just go be selective and say, I want to buy in Tampa, Florida or Orlando, Florida. I could, but I probably wouldn't own anything at this point in time. So we've got to be very diverse in nature, but I think it's also beneficial because we own in so many different markets. And so, as everyone says, the real estate cycle, it's local. I mean, it really is. I mean, it doesn't necessarily affect in a broad spectrum the entire U.S. the same way. And so moving forward, being diverse in that nature, I think is going to really help us protect ourselves, when we go through another cycle, which we inevitably will.
It reminds me of what Mark Macias says. He wants to have a building or an investment in every major city so he can diversify and play the arbitrage between markets. I hear that. Okay, so now you're raising a $10 million fund. You've had great success. You have the lifestyle you want. You have the life you want. You got your kids set up. What's the point? Why keep going? What's the deal?
I mean, there's multiple points. I mean, there's the diversification of risk factor that's involved. I mean, there's also the factor of I don't have all the money in the world. I can't do all the deals by myself. And even if I could, it still wouldn't make financial sense to do so from a risk perspective. So there's also the idea of being able to strike when an opportunity is hot. I know that there were certain opportunities that we missed out on in 2011, 2012, when there was a lot of distressed assets out in the marketplace that it stung because I saw them coming past us and we couldn't pounce on them fast enough. We didn't have the capital at hand to do it. So I think it just allows us to be a little bit more nimble on our feet. In addition to that, I feel like we're adding value to investors. I feel like we're doing something of huge value to those that are out there that are seeking better returns on their money. And I'm speaking to our passive investors. So it allows us to really give back in a way that we're helping others that maybe don't have the ability to get in an active standpoint. They want to be passive, but they want to invest in real estate, and they want to diversify their own portfolio. And so we're helping them achieve that. So and there's multiple different reasons, but there's just a couple of top ones that I have.
All right, I appreciate that. So it sounds like, and I'm gonna throw a little bit more in there because our conversation from before this, there was also the desire to give back and an element of legacy to it as well.
Yeah, absolutely. I mean, someone asked me, and I've had multiple conversations here over the past day and a half. Someone asked me, what's your goal, Kevin? Like, how many units do you want to own? And for me, it's not really about it doesn't really come from like a unit perspective. It's more of like, I just want to buy deals that make sense. So that's first and foremost. Like, I don't care if it's 5, 50, 500, 5,000 over the next year, 5 years, 10 years. I just want to buy deals that make sense and make money and they're going to support our investors' needs, they're going to support our needs. And so that's one of our big goals. But also, I'm involved in a lot of charitable endeavors. And the reason why I keep doing this, I mean, let me start before I mention that. I love what I do. Like, I love this business. I don't look at it as work. And so when you say, like, Kevin, you've got kind of like the lifestyle you want, your kids are happy, your family's set up, this, that, and the other, like, why are you doing this $10 million fund? Why are you going to that point? Because it doesn't seem like you really need to do it anymore. And that's not necessarily the truth, because I still need a little bit more to really reach some of the, lifestyle
the loftier
goals that I have. But anyway,
bigger boats.
Yeah. I really enjoy giving back, and I'm one of my big hobbies. I'm a cyclist. I do a lot of long distance events, and it's just become a passion of mine over the past like 7 to 8 years. And I started a couple of charitable endeavors, I guess about 7 years ago. And they take a lot of my time. One of them is I take myself and 65 other cyclists down the Key West from Fort Myers Beach. It's like 300 miles over 3 days. We raise a whole bunch of money, and we feed a lot of local families over Christmas time in Tampa Bay market. And I'm a director of it. I organize it. It takes a lot of effort and a lot of energy. Doing what I do allows me the flexibility to actually be intimately involved in that. Like, I don't want to just make money and just give money out to charities. I actually like to pair it up with my passions. And so real estate allows me the ability to actually have the time and flexibility to pair it up with my passions, actually give back in a bigger way.
I love that. Awesome. We are all always thinking about giving back. Every podcast Joe has, one of his questions is, what is your best ever way to give back? So I love that you threw that out there. So switching gears a little bit, because no matter whether you're a passive investor or an active investor, at some point, hopefully you have a ton of money and you want to keep it, right? So I'm curious, Jeremy, because once you start snowballing it and you have it, to some degree, you become a passive investor in potentially other people's deals to diversify outside of your own stuff. But I'm curious, Jeremy, why did you choose to be a passive investor instead of an active one?
Yeah, so I started back in 2002 when I was in the corporate world, and I had a very busy job. I was at Disney headquarters, and I was actually on, I remember, they wouldn't give me a damn cell phone. I hate the corporate world. And I was like on my cell phone in the elevator in this like 40-story building, making calls to people in between meetings, because I was literally that busy. And so I was not able to do the active side. I didn't have the confidence that I was going to be able to learn everything I needed to learn about any specific asset class and do it really well with the amount of work that I was doing. So,
and no point along the last decade did that change?
No, you know what? It's interesting. I had this active versus passive conversation with a lot of new investors, and I would say probably the first thing you need to do if you're brand new is decide if you want to be active or passive, because people tend to not do both. They could transition from one to the other after a while, but typically it comes down to personality, because it's a question of control. So I was very comfortable giving up control because I didn't have the time. But the truth is, if I didn't have the right personality, no matter how busy I was in the corporate world, it wouldn't matter. I wouldn't feel comfortable going on to the passive side. So once I started down passive and I just did more of it, I just became more comfortable, and it was a non-issue for me. And what I like to tell people too is, if you're new and you're not sure what you want to do, and then you start going down, say, the passive side, and then 5 deals later, you're like, you know what, I'm not comfortable giving up control. There's two problems. The first is that it's very illiquid when you invest passively. You can't just press sell on a screen. And so, it might take a while to sell. You're actually not allowed to legally to sell your shares for the first year when you actually own a passive opportunity or piece of. And so that's problem number one. And problem number two is now you're down a path where you're not actually properly diversified, which is as big a problem. And so you really need to take the time in advance to think about that before you go down one of those paths, because it's actually hard to unwind from both of them. And it depends on the asset class. Even the active side may not be so easy to sell. It might be the wrong time in the cycle to sell. There might be other issues. So that's a really important first step. So once I started going down passive and I was really comfortable with it, it just made sense to just keep going down further and further, because to me, diversification is absolutely key, and you're not getting the real full diversification until you're down the path for at least a few years.
All right,
So.
awesome. And you know, I've been curious about this since the first time we talked. How much time does it actually take you to be a passive investor? Is it truly passive? I mean, you're managing 70 different deals, the communications, the evaluations, the meeting people, the networking.
Right.
How passive is being a passive investor?
Yeah, so there's different levels of being a passive investor, I think. And I may not be the best example because I also manage an investor group, and so that takes some of my time. But when I see different levels of being a passive investor, you can either be part-time or full-time. So if you're part-time, when you're in the corporate world, say you're trying to get out, then it's really a question of going to as many networking events as you can, trying to find opportunities, maybe going on the crowdfunding sites, which when I started wasn't out there, so I just have to go to network. And you have to put your time in it to network and find the deals. And really, I tell people that I don't think it's realistic. If you had $1 million right now and you said, how do I get this into 20 deals and diversify it? You can either go down the crowdfunding path, download 50 deals, choose 20, and you're done. Or you can try and find these deals directly, which is what I've done. And frankly, in the direct method, if you're going to be really picky, I would tell somebody it's 20 deals. I mean, I would say very aggressively 2 years and much more relaxed 5 or more years. That's realistic. So it's something that takes time. And so, that's just the name of the game. That's just the way it works.
Fair enough. And okay, so I'm going to ask you a question. I know you're going to hate this question because it's so vague and so subjective, but you are so mathematical and so methodical about the way you are going from 2007 to whatever point you're getting to. So perhaps wrapping it with your own personal ambitions, what is the math that you're using to get from today or 10 years ago to that endpoint in I made it, whatever that is? What is the math that you're using to snowball the seed?
Yeah, so it's very subjective to your point, right? So there's no real proper answer. We ask everybody in this room, everyone may have a different answer. So when I first started, I was hoping to get to $10 million net worth, and the reason why I had that in mind is because I figured, okay, 10% cash flow, $1 million cash flow a year, very good situation. And by the way, I live in LA, just south of Beverly Hills. So if I was in Iowa, it might be a little different, but that's the reality of where I live. It's really expensive, but as I started going, it occurred to me, I really shouldn't think of it as net worth. I should really think of it as cash flow, because I want to be at a certain coverage of the cost of living. So what I like to tell people is my end goal is 3 times cost of living, which again, in where I live is very, very high. I mean, I have 2 kids. You would not believe what it is. Yeah. So, and I'm not there yet. I think I'll be there hopefully in 5-10 years. And I think at that point, for someone as conservative as me and someone who's always worried, that'll be a really nice cushion. But I think to Kevin's point, I think what's going to happen is that, if and when I get to 3 times cost of living, I don't think I'm going to stop. I love what I'm doing. To your point, I love what I'm doing. And so I don't know why I would do something else. So right. I don't know why I would stop. Right. So hopefully it'll just keep going.
Awesome. Okay, so the last question, and this is for all 3 of you guys, and we'll start with Sean. 2017 is just kicking off. We're talking about building an empire. What's one takeaway from the last 2 days that you're going to wrap into your tactics and strategies for the year to continue to build that empire, whatever that means for you?
That's a good question. I'm going to maybe take a little bit different approach, or maybe I'll be a little different than maybe what you guys will say. Can you cue that slide up for me? So I was talking earlier, and Chris, I'm going to use the word you told me, patience. If you look at the slide, I don't know which one is on your right or left.
It's this guy over here.
Let's look at this. I'm talking about this one right here. This is not a perfect science. This is subjective like anything, but one of the leading real estate economists that our firm follows every quarter publishes where we are in the apartment cycle. And if you look, it shows it shows a handful of larger markets around the country. Everything is, in my opinion, peaking and or moving maybe slowly down on the other side. What does that mean as a takeaway? Does it mean run for the hills? Does it mean, here comes 2007 again? No, it doesn't mean any of that. But what it means is we've had a phenomenal run, 2010/11 to let's call it December 31st of 2016. Deals have been plentiful, deals work, interest rates are low. I went to a conference a couple weeks ago. They described the last 6 years as the perfect storm for the multifamily industry, frankly, of all time. I mean, it's the greatest 6 years to buy apartments probably that's ever existed. And so many factors played into that. And one of the biggest takeaways I took from it was, and one of the guys made the quote, we're going from a great apartment market to a very good apartment market. So what that means is my big takeaway from that, and what I, if anything, would like to put out to folks to at least think about and keep in mind as you're looking for deals in the coming years, is I don't think the bottom's falling out. I don't think, again, as I said, we're not running for the hills, but if you're looking at short-term exits, if you're looking to get into a deal, turn it around and sell it in 2 or 3 years, keep in mind where we might possibly be, in some people's opinions, in the cycle, and keep that in mind as you're looking at properties, as you're looking at business plans, as you're trying to think about, if I buy this deal, what's my exit strategy? What do I, and one of the things I would say that frankly, I haven't done much of in the past 6 years is run what's called a sensitivity analysis. What happens if I buy this deal and rents go down 5%? What happens if I buy this deal and this happens or that happens? It's pretty much been, buy this deal, everything's going up, I'm gonna look like a hero. That's not maybe gonna happen over the next few years. So as you're evaluating deals and looking to make purchases, just run the analysis of, what happens if rents go down? What happens if I need to sell this in 3 years and I bought it at a 4.5% interest rate and now interest rates are at 6.5%? Hopefully Kathy's right and they don't go anywhere. We'll all be happy about that. But just think about if they do, what's your game plan? And what are you gonna do? So that would be one of my things to pass on, I think, right now.
Thank you, Sean. That's a very cool visual to share.
Ben, I was going to just point something out for the crowd, actually.
Sure. Derek, can we
Sorry.
get back to that guy? Thanks.
Just because I know a lot of you guys invest in Denver, so the left is industrial, the right's multifamily. I've seen this before. This is really great. Just so you know, multifamily, because I'm sure most of you can't see it, Denver is at number 13 on the multifamily scale. Can you guys see where 13 is? Yeah, okay.
Wrong side of the mountain.
Hyper supply. And hyper supply means rents are still growing, but basically this will be the first year that supply will now outstrip demand.
Powerful slide. All right. Thank you, Sean. Same question, Kevin.
Yeah, I think that it somewhat piggybacks on a little bit of what Sean's saying is, I think you just need to be really cautious. I mean, again, it's all these markets are different, all these asset classes are different, they all hit cycles at different points in time, but I think that whatever you're going to get into, just be very cautious and don't get stuck on, I want to buy X number of units over X period of time. I mean, just make sure that you're very cautious with what you're buying, you understand it, and you also understand your exit. I mean, again, piggybacks on what you say there, Sean, but always go into it knowing what your exit strategy is going to be, knowing that like if you hit like a worst case scenario, whatever that might be in terms of an occupancy hit, or if your rents don't go up 4 to 5% each and every year for the next 10 years, if you don't have that, if you get some kind of just period of time, 4 or 5 years where you have no acceleration in growth in terms of rents, what are you going to do? I mean, what's your exit out of that deal, or how's it going to operate? I mean, how's it going to perform based on what your projections were? So just be very cautious. And there's one other thing I'd like to mention that I think was a good takeaway, and it's something that I'm already doing myself personally, but it's Chris Clothier had mentioned it earlier about, if you want to get to where you want to be with whatever you want to invest in, just work your butt off. Like, just plan on working your butt off. And in markets like this, to find really good opportunities, you got to work your butt off even harder. But here's the good thing about that, is that if you can figure out how to find really good opportunities in this type of market where it's really tight, and I don't care what asset class you're in, it's really tight to find any good, what I would consider to be really good opportunities, strong opportunities that can stand the test of time. If you get really good and you work your butt off to find those, when the cycles change a little bit to our favor as being buyers, you should be able to kill it. You should be able to absolutely kill it. So, but it's going to take a lot of hard work, a lot of consistency and persistence, and probably a lot of roadblocks that you just got to push through, but just be willing to work your butt off. So I think that's what I'll leave you guys with.
Powerful. Thank you, Kevin. And, Jeremy, same question.
Yeah, and I would definitely, again, tone of caution. It's interesting, as a passive investor, one of the...
Yellow lights across the board.
Yeah, no, but I mean, that's interesting. As a passive investor, one of my jobs is to actually look at trends in the future, but also follow the cycles. So I'm a little bit different because these guys focus on a specific asset class. I'm focused on all the asset classes. So I actually change what I invest in depending where we are in the cycle. I rotate through stuff, and for various reasons. And so it's interesting to consider, as a passive investor, I have to think 5 to 10 years ahead because I'm going to get locked into a deal. Typically, it has a 5 or 10-year term. So that means that back in 2013, I literally started investing for a recession in 2013, thinking it was going to happen around 2018, because if I wasn't anticipating that, if I went into the wrong thing, that could have a huge problem in a recession. I'm going to be in trouble, but I'm locked in and I don't have any control. So I've been investing for a recession since 2013, and what I'm planning on doing is whenever we have a recession and or an adjustment, that's when I can really jump in and take advantage, just like you're talking about. But even though I believe we're very close to that, it's not good enough for me to just have decided that today. I had to decide that years ago. Mm-hmm. So one of the most important things you could do to protect yourself as a passive investor is to really look at the economic trends. I read about an hour or two of news a day, and most of it is actually, none of it is like CNN and ABC. It's all the data. It's actually all going into the charts. What Kathy was looking at, what you brought in. Thank you for bringing those charts. That's what you really have to look at. You got to get out of the weeds of the media and follow the charts and understand where we really are, because everyone's going to be pitching you these deals, and they all look great, and they all have these great markets that they're investing in, but you have to understand the bigger picture and what's going to happen in 5 or 10 years from now. And it's actually not even about the cycles, it's about the trends too. So great example is Amazon just recently announced, and someone mentioned it yesterday, that they're thinking of opening up some grocery stores, which is really interesting. But what's even more interesting about it is that the grocery store footprint they're looking to have is about half the size of a typical grocery store today. What does that mean? That means if you invest in a grocery anchored center, and the entire business model shifts in less than 10 years from now as a passive investor, they could be looking to cut that footprint in half. So you've got to be ahead of the trends. Internet is taking away some of the retailers. Retail is a really easy example. Mm-hmm. Office buildings, depending on where you are, more people working from home. What does that mean in 5 or 10 years from now, which is a long time from now? So even self-driving cars, what does that mean for what makes sense, what you're investing in, depending on the asset class? So you really got to take all these things into account and really think far ahead. And so what I would leave you with today is, if you're thinking of being a passive investor, you are one, you've got to think very far ahead. And if you're just starting, I'd be very, very cautious right now, to reiterate what these guys are saying.
So the 1, 2, 3 is look at the trends, work your butt off, be aware of where we are in the market cycle, and be cautious overall, but hopefully optimistic at the same time.
Not doom and gloom.
If you're under the age of 60, you're going to be in this business for the next 20, 30, 40 years, you're going to go through 3 of these or 4 of these. So you might as well learn how to, it's not, if real estate was smooth sailing for 40 years, we'd all be billionaires and be retired.
But the
trick is learning to navigate.
I do want to say that this demographic shift that some people have touched upon, like Kathy today, is huge. And actually, I think it represents a huge opportunity for everyone in the room, because it's one of the most obvious things that's going to happen for the next 20 to 30 years. We know the incomes are pretty low, and we know that the boomers are retiring. And if you can take advantage of that in real estate and look at where the population is shifting, but also how they're going to spend that money and what type of asset classes they're going to demand from or not, you potentially stand to profit. So we may sound doom and gloom, but there's actually a lot of opportunity on the horizon that's kind of obvious.
That's a powerful ending.
Just watch out for the robots.
Yeah. No, it's true.
Time for 2 questions. Joe.
Jeremy, when you reach your end goal of 3 times cost of living, you'll have that chunk of money, right? What will you do with that chunk of money to make sure it doesn't get eaten away by inflation?
So to repeat the question, what is Jeremy going to do with his giant chunk of change so it doesn't get eaten away by inflation?
The hypothetical chunk of change down the road.
In 10 years.
Yeah. That's a great question. Inflation, it's interesting. I don't know how many of you here have heard of shadowstats.com? Okay, wow, very few. You need to go to shadowstats.com. What that shows you is what the real inflation is today versus how they used to calculate it. They've changed the way they calculate it. The government purposely changed the way they calculated in 1982, and they actually changed from rent to price of a home or vice versa, I can't remember which, so that the numbers would look lower than they are. That's actually how they make it look still okay. So the real numbers are more, at the moment, I think like 6 to 8% a year, in the typical basket. It's not what they're actually using. They're using it for Social Security to be able to inflation index at a lower number and everything else. So anyway, so my goal is to always end up ahead of inflation every year. So it's not just about at that time, it's even now. So when I have certain cash flow targets, like my minimum target year one going into a deal is 9% projected net to investors. My minimum 10-year average annualized cash flow is 11%, and I'm a very heavy cash flow investor. That's what I focus on. And so when I'm hitting those targets, I'm pretty much staying in line with or ahead of inflation. So Joe, just to answer your question, like I'm not really going to change much. I'm just going to keep going into stuff that I think is either going to hit or exceed inflation, which is a lot higher than most people realize today.
Can you repeat that website? What was that website again, Jeremy?
It's called shadowstats.com.
Stats, okay.
And what's great about the
Shadow
website, they actually show many, many other things that the government has modified over time to make it look better than it is. It's not just inflation. Because all they do is just go back and actually they show you the curve of like the chart of what the current chart shows and what it would show if they used the old calculation.
Yeah.
Yeah, it's really
Wow.
interesting.
So nuggets like that are what make like these conversations worthwhile. Like 2 people knew about shadow stats, and we're all probably going to go Google that later tonight. Awesome. One more question, Scott.
This one's for Jeremy. Just to get your take on Carnegie's quote about putting all of your eggs in one basket and watching that basket very closely.
Yeah. Okay. Did everyone hear that? It's a question about putting all your eggs in one basket and watching that basket closely. So are you asking that question in general, or are you saying from a passive investor perspective?
So earlier, you referenced that you really like diversification and you're looking at many asset classes.
Yeah.
The other presenters do the conference over the last 2 days and talk about the focus.
Right.
Focusing on one particular asset class. So you are the black sheep of the folks that have been up there so far. But each person can specialize in one asset class. You're looking across a wide spectrum.
Yeah. So that's a good point. So for those of you who didn't hear, the point was that I am different than the other two in that I am more diversification strategy where they're single asset focus. And so I think that the big difference is that they're running a business, and so I think that on their side of the table being the operator, I think it makes a lot of sense to actually focus on one asset class. And to be honest, as an investor, if I see an operator focused on more than, say, 2 asset classes max, I get very worried. I feel like that person may be scattered. They may not know enough about each asset class. So I think that makes a lot of sense. For someone like me, where I'm trying to leverage, because I'm actually leveraging other people's time. Right, that's what I'm doing, and I'm trying to find the right people to make bets on. So for me, the all eggs in one basket is probably a bad idea, because if I make a bet on the wrong person, I'm just going to go to zero. So I do the exact opposite. And I can tell you I diversify across operators, asset classes, and geographies. That's how I work. And so I try not to put too much with one operator, try not to put too much in one location, and certainly not in one asset class. Just because, and by the way, the asset classes are particularly important because, as we've talked about during the conference, there are certain asset classes that obviously do well in the downturn: self-storage, mobile home parks, and there's some others too. And I need to balance that potentially with other asset classes I'm in, especially in a downturn. My goal is to go to sleep tonight, wake up tomorrow, and nothing has changed, right? Because I live off the cash flow. So that's why I needed diversification for that.
Awesome. Jeremy, Kevin, Sean, thank you guys very, very much for your time. It was wonderful. Really appreciate it.